On March 28, 2022, something happened in a government building in Riyadh, Saudi Arabia, that would have been unthinkable 6 months earlier. A senior Saudi minister confirmed in an interview with the Wall Street Journal that the kingdom was in active discussions with China to price oil sales in Chinese yuan, not dollars, yuan. A country that had sold every barrel of oil in dollars since 1974 as part of a formal agreement with the United States was now openly discussing ending that arrangement. The U.S. Treasury Department declined to comment. The Federal Reserve declined to comment. The President declined to comment. For 78 years, the U.S. dollar has been the bedrock of global finance, the world's undisputed reserve currency. Its stability was taken for granted. But in the 6 months following the March 2022 sanctions on Russia, sanctions that froze $300 billion in Russian sovereign reserves held in Western financial institutions, more than 40 countries quietly began conversations about what it would mean to hold fewer dollars. This is where the unraveling begins. Not with a sudden catastrophic crash, not with a formal press release. It starts with a single, powerful question that 40 governments started asking at the same time. What happens to a country that holds dollars when America decides to use those dollars as a weapon? History shows that reserve currency status is not permanent. It is a negotiated arrangement, and behind closed doors, the renegotiation has already begun. For most Americans, the dollar's role as the world's reserve currency is an abstract concept, if it's known at all. It's simply the money they use every day, and its global power is often assumed to be a permanent fixture of the modern world. But it is neither permanent nor preordained. The dollar's reign is the result of a specific historical moment, the Bretton Woods Agreement of 1944. Emerging from World War II as the world's dominant economic power, the United States held 2/3 of the world's gold reserves. This allowed it to plausibly guarantee that every dollar was backed by a fixed quantity of gold. When President Nixon ended that guarantee in 1971, the infamous Nixon shock, the dollar's reserve status should have crumbled. It survived only because of a brilliant strategic pivot, the Petrodollar arrangement. This 1974 agreement between the U.S. and Saudi Arabia mandated that all OPEC oil sales be priced in dollars, in exchange for American military protection. That new arrangement no longer required the dollar to be backed by gold. It required the dollar to be backed by oil. Every country on Earth that needed oil to power its economy, which was every country on Earth, now needed a constant supply of dollars to buy it. This forced every central bank on Earth to hold vast quantities of dollars in reserve. This created immense artificial demand for U.S. debt, giving the United States the ability to borrow at lower rates than any other country in history. This is the exorbitant privilege that funded the deficit spending that built the modern American military, the American welfare state, and the American financial system. The petrodollar arrangement is why America can run a $2 trillion annual deficit without a currency collapse. It is why the United States can sanction other countries through the dollar system. It is why, for 80 years, being American has meant having access to cheap credit that no other population on Earth has ever experienced. And it is ending. Not overnight, but measurably, systematically, and faster than any U.S. government official is willing to publicly acknowledge. 3 data points, each one a separate piece of the same accelerating pattern. First, central bank gold purchases. In 2022 and 2023, central banks around the world bought gold at the highest rate recorded since 1967. Not bonds, not dollars, gold. The countries driving those purchases include China, Russia, India, Turkey, Poland, and Singapore. China alone added more than 200 tons of gold to its reserves between 2022 and 2024. Central banks do not buy gold for sentimental reasons. They buy gold when they are reducing exposure to assets denominated in currencies they no longer fully trust. The signal is unambiguous. Second, BRICS expansion. The BRICS economic bloc, Brazil, Russia, India, China, South Africa, formally expanded in January 2024 to include Saudi Arabia, the UAE, Iran, Egypt, Ethiopia, and Argentina. The expanded bloc now represents 45% of global population and approximately 35% of world GDP. At the 2023 BRICS summit in Johannesburg, the official agenda included discussion of a new reserve currency, one backed by a basket of member currencies and commodities, to reduce dependence on the dollar for trade settlement. The proposal has not been finalized. The conversation is live. Third, bilateral currency trade agreements. Since 2022, China has signed bilateral trade agreements denominated in yuan with Brazil, Russia, France, the first G7 country to complete a yuan-settled LNG transaction in March 2023, Saudi Arabia, and more than 20 other countries across Asia, Africa, and Latin America. Each individual agreement is presented as a trade convenience. In aggregate, they represent the construction of a parallel financial architecture, a shadow dollar system, that bypasses U.S. jurisdiction entirely. Now, here is what all of this means for your daily life, in terms that no official briefing will provide. This isn't just abstract economics, it's the hidden architecture of your world. The dollar's reserve status is effectively a tax on the rest of the world, a hidden tribute paid by nearly every other nation for the privilege of participating in the global economy. Every country that holds dollars in reserve is holding an asset that loses purchasing power through U.S. inflation. Their savings effectively shrink to subsidize American monetary policy. Every country that buys oil in dollars first converts its own currency to dollars, paying exchange fees and subjecting its trade to U.S. financial system jurisdiction. That tax, extracted invisibly from 150 or more countries for 80 years, has funded American consumption far beyond what American productivity alone would support. Americans buy more than they produce. The gap is covered by the willingness of the rest of the world to hold the paper that represents American debt. If that willingness declines, if dollar holdings in global reserves drop from the current 58% to, say, 40%, the consequences flow directly to American consumers. Import prices rise. Interest rates rise to attract capital that previously arrived automatically. The U.S. government must pay more to borrow. Social programs, military budgets, and infrastructure spending all become harder to fund. The entire federal balance sheet comes under pressure. The standard of living that 330 million Americans treat as a baseline, the cheap goods, the low mortgage rates, the global purchasing power of the dollar in your pocket, was always partially subsidized by the rest of the world. This global arrangement has been the bedrock of American prosperity, and the rest of the world is beginning to notice. The Federal Reserve calls this risk manageable. Treasury officials call it overblown. American financial media calls it the de-dollarization myth. These are the same institutions that called inflation transitory in 2021. The dollar will not collapse tomorrow. It may not collapse in the next 10 years. The transition from one reserve currency to another takes decades. The pound sterling's displacement by the dollar took 30 years, from 1914 to 1944, and the pound is still a major global currency today. But during those 30 years, British citizens experienced the slow, grinding erosion of purchasing power, geopolitical influence, and economic security that comes when the world stops needing your currency quite as badly as it once did. The question you need to ask is not whether this is happening. The data says it is. The question is whether the people who benefit most from dollar dominance, the banks, the treasury, the financial institutions whose global power depends on everyone else needing dollars, have any incentive to tell you how far along this transition already is. The answer to that question should tell you everything about why you haven't heard this explained clearly before tonight.